Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right, everybody, welcome to Wealth Wisdom. I'm Justin Obi, and today we're tackling one of the most misunderstood pieces of the investment puzzle is real estate. We're excited to get into this. Mortgage rates are about 6.2, jumping up and down, but most homeowners are locked in at rates under 4.5. The traditional real estate playbook has basically been completely rewritten, or maybe it has. We'll see. We want to dive into what smart investors are doing today, how they're adapting, and we'll get into that. Joining me, as always, is the amazing Eric Benz, co-founder, principal of Fox Hill Wealth Management. And today we have a special guest, Paul Nardozzi, Manager Director of Forum. We're very excited to have Paul here. He brings over 20 years of experience specializing in real estate debt, credit, and equity strategies. He's very experienced in the investment world. And Forum is a major player in alternative real estate with credit, debt, and equity plays. Paul oversees their entire Northeast territory, and we're excited to have you here. Paul, big welcome to the show, man. Thank you so much for being here.
Thank you. Happy to be here. Thanks for having me. Excited about this.
So let's get into it real today. Just let the people know, all our listeners, this week was, I don't know, the big announcement was the Fed has lowered very expectedly. Everyone knew this was coming. They lowered rates by 25 basis points, excuse me. Paul, what's your first take on this? Is it like a big nothing burger, or what are you thinking?
Yeah, what's interesting is the last few times the Fed has lowered rates, we've seen the 10-year actually go higher.
Yeah.
And so it's had the inverse reaction of what I think a lot of people would expect. And so for our area, we expected rates to be higher for longer. That's the view that we've been taking. So for us, it really is a big nothing burger. We've been preparing for this, and it wouldn't change the way we're looking at the real estate space whatsoever.
Mm-hmm. Okay. Yeah, that's been interesting. I think it's happened, what you just described, the 10-year going up, has happened on the past 3 cuts, which always shocks people. They're like, wait, what? I was expecting a lower mortgage, lower credit, etc. What's happening?
It's no longer directly correlated. Short-term rates aren't necessarily translating directly to mortgage rates. And as much as the president wants to open up the real estate market, it's very intriguing right now. As you've mentioned, we have high mortgage rates, but we have a bunch of people locked in at lower rates.
Yeah.
And so they're very hesitant to sell. And so on the single family side, it's really a logjam that's causing prices to go much higher if anyone's going to enter the space, but it's also making it much more difficult for the average person to buy into a home. When I was just getting started and my wife and I were buying our first home, luckily my parents were able to help us with the down payment, which was a normal rite of passage, right? You got a check from your parents, you end up paying them back, and you got into your home. Nowadays, you not only need help with the down payment, you need help with the monthly payments. And so what it's doing is it's causing more and more people to enter the rental space. We actually study the price difference of owning a home versus renting. And currently it's 34% higher on a monthly basis to own a home than it is to rent. And so that's why we're starting to see such a rush, an increase in demand into the multifamily specific rental space.
And Paul, does that even count like maintenance and things along
That
those
is
lines
not
too?
maintenance. That is literally just down payment and mortgage and taxes, just calculating. So I know, as we all know, as homeowners, something's always broken, right? And we were just talking, just talking about ordering firewood. There's $500 check, right? Or that adds on to that monthly payment. So yes, it's very expensive to own at this point in time.
So are you also seeing rents go up in price as well?
Yeah, rents are depending on location. So we've seen a little bit of stagnant rent growth in certain areas, consistent areas where there really hasn't been too much job growth. We study two things. We study job growth and one-way U-Haul rentals. Those are our two top line
I like that.
predictors of rent growth and where we would even develop. And so in our large job growth areas, like if you want to mention like Sun Belts or the Arizonas of the world or the South Carolinas, North Carolinas, Georgias, rent growth is starting to increase because we peaked in supply of apartments about third quarter of last year. And now that supply's come off, but demand is still accelerating. And so that relationship is moving heavily in favor of rents going higher at this point.
Got it. That's really interesting. Is it? Yeah. Okay. I was gonna say, is it also
more stress, right, on the consumer, right, as rents?
What was that, Bill? I didn't hear you.
No, I was just saying it's like putting even more stress on people who are trying to save and maybe potentially buy eventually. So
and to add to it, I think you have a generational change. I'm 49. I feel like my whole life was written for me. It was, you're going to go to college, you're going to find a significant other, you're going to buy a home, and that's it. And I bought my first home pretty young. But my nephew is now 28. He lives in New York City. No chance he's buying anything within the next 5 years. His sister's 2 years younger. His brother's younger. My daughter's in college. I can't see her buying anything for a long period of time. And then we're also seeing a lot of retirees that no longer want to own. They just want to pay the rent and have everything taken care of for them. And so it's a massive switch away from home ownership and towards the rental space. So we think it all bodes well for what we do.
That's really interesting. I got a million questions here, but I want to take this back. We're going to get through this news segment here, but there's a lot. We're going to revisit that. We had a wild week in tech. NVIDIA keeps crowning kings. NVIDIA hit their $5 trillion valuation. AI is eating the world. Apple joined the 4 trillion club, so that's big news. And NVIDIA made a $1 billion stake in Nokia, boosting Nokia, flew through the roof at 21%. At the same time, and maybe this plays into what we were just talking about, this may be affordability, but jobs, and this is part of why the Fed just cut rates, because they're trying to balance the jobs and inflation. But Amazon, this big announcement, announcing 14,000 cuts coming, UPS / 34,000 jobs. And Chegg, which is an educational support services company, cut 45% of the workforce due to AI. I don't think UPS was not related to the AI piece, but we're seeing a lot of job cuts. So, Bill, what are we thinking here?
Automation, right?
What are we thinking, guys?
That's why I think UPS, right? That was in relation to, have they cut ties completely with Amazon? I believe that's why some new things are happening.
That's right, yep.
Yeah, as we see more of that stuff, that getting those goods to the consumers, more of that stuff becomes automated. We're probably going to see more of those jobs get slashed, right? So it'll be interesting to see what happens in the next 5 to 7 years as that stuff takes off even more.
Yeah. I heard an interesting take. I don't know if this is true, so I'll just throw that out as it might be not, it may be wrong. But part of the reason that Amazon is cutting so many jobs is to afford better chips, because they need to plow. AWS supposedly doesn't have enough bandwidth that people are asking for. And we just saw the big outage that AWS had last week, and took down almost half the internet, maybe more. But in order to spend more on AI and these more expensive chips, data centers, etc., that's their number one thing. And so investors want to see them plow money into what makes them money. What do you guys think of that take?
They said it was the culture was why they cut it. So I don't know how much.
I don't know. Again, rumor mill.
No, I'm laughing at
it's the hot goss. That's the hot goss. I don't know if it's true or not, but I just wanted to get your opinions. Eric, any take on that? Do you think it's true, false?
Yeah, I mean, they made a decision from the top that they're not going to be, the larger investment's not going to be in the people. It's going to be in the build out, the data center build out. You see, which we'll get to, like how much Facebook's going to be spending in the future. You have to figure that the rest will follow as well. Even though investors are a little bit concerned about Facebook's spend.
Yeah. Well,
I want to say too, the AWS is 60+% of their income.
Yeah, and I think it's 80-90% margins.
Yeah.
What are you going to invest in?
Obviously, want to focus on that, right?
Yeah. Obviously, investors aren't so happy with Meta, even though they hit earnings, a stock holding of ours. They hit earnings. They did well in their earnings report, but their stock took a 12% hit. Is this a momentary thing? Bill, what do you think? Paul, any thoughts on Amazon, Meta?
Here, let me say this. This has happened before with Meta, with the metaverse. It was like 3 years ago. Facebook announced they were going to be spending just absurd amounts of money to build out the metaverse. Investors got spooked. The stock tanked. I can't even remember what the total percentage was. Almost like 50%, I want to say, maybe even more. And rallied from there. It's now up like drastically. I think maybe it's a little market overreaction. But just so you guys know, I pulled up a number. This is from JP Morgan Research. Along the same line, so management increased its outlook for 2026 total expenses to grow significantly faster, and they project it to be, this is just for the data center build out stuff, that 153 billion. So that's a 30% increase just for 2026. So that's what had investors spooked, is Meta's playing catch up with Google and Amazon. They don't have the same capacity that they do. But so here's the note, is given uncertainty around the timing of superintelligence, Meta's still committed to its strategy of aggressively front loading the capacity build out. So we still don't know what AI is gonna look like, what the supercompute's gonna look like. But Meta's saying they know it's gonna be profitable, they know it's gonna work, and they're gonna build out in preparation for when AI kind of gets there. But has people a little worried.
Yeah. And Zuckerberg said that he's perfectly comfortable with overspending, as long as they don't miss. So I'm fine with spending like a couple $100 billion more than we should have, as long as we don't miss out the opportunities.
But Bill, who does this benefit, right?
Spending.
If Meta is going to keep spending,
again, the picks and shovel companies of the AI build out. So companies like Arista Networks, NVIDIA,
Energy,
Amphenol, like all these companies that have all the goods and everything like that for these are going to do really well, and we've seen them do past few days. There are holdings of ours that have held up and gone up with some of this news.
Maybe
I would expect them to continue to go up.
Forum should add as a data point, wherever Meta's spending money in the country, that's where they should build apartments.
That is something we will consider, and we've been lending to the AI data center build-outs. That's just another potential customer to lend to. And I'll give you a personal anecdote. I've got a friend who did some work for Meta, and I will tell you, there was never a focus on cost. It was like, just get it done, get the project done. Pretty incredible.
Yeah, wow. The data centers are pumping. We've talked about that on the show numerous times. How does let's dive back into real estate and in your world, Paul. Yep. How are data centers? How are you looking at it? Are you looking at them as two mutually different things? So you've got data centers, and then there's also news on real estate and how is it affecting prices? If a data center goes in near you, there's been anecdotally a couple news stories I've seen where it's not a great thing, but we need it. So
almost like solar panels, like when people paint solar panels in their neighborhood.
It's funny. We haven't focused on this yet. That would be more of our equity vehicle decision making.
Okay.
We've just taken a look from our debt vehicle standpoint, and so much development has to occur before we even get to a happy place with how much data center power there is. And so if we can find the best developers in the space and become their primary lender, it's a good scenario for our debt fund moving forward.
Oh, absolutely. No doubt about it. So are you guys investing where, like in Texas, Abilene, and places like that?
Ohio.
Okay.
Yep. So we're lending to folks that are developing in both those spots.
Okay. Okay, cool. So let's just take a step back. What's the elevator pitch for Forum? So everyone knows I probably did a bad job. Give us the 2-second spiel here.
Yeah. Our philosophy is we want to empower individual investors. What do we mean by that? Commercial real estate's a sector of the market that's really been taken advantage of by large insurance companies and the ultra wealthy for decades. Our founder and CEO, his name is Darren Fisk. He started our firm in 2007. He grew up very humbly and had a vision and executed the vision, has done very, very well for himself. But one of his two first investors were his mom and dad with $20,000 and his sister with $8,000. And over the last, let's say, 18, 19 years, they've made quite a bit of money investing with the fund, with the firm. And we want to bring that ability to invest in areas that have been selfishly held for, again, large insurance companies and the ultra wealthy to the general public who, that's what we mean by empowering individual investors. And we take that very seriously. There's three things you need in life, right? Food, water, and shelter.
Yeah.
We're in the shelter business. And we allow others with some point, for some of our vehicles, no investor restrictions to invest alongside of us and be there for the ride. So that's how we view the investing world. It's very different than other firms that are built a lot of times with a greed bias. Ours is a sharing bias.
Very cool. Is it a REIT? It's probably a dumb question.
Well, we have a few different vehicles.
Okay.
We do have one of our more equity-based vehicle is structured as a private, non-traded REIT. So it's privately purchased through us. You can't buy it publicly. We also have a debt vehicle that is available through a ticker symbol, but we structured it as a REIT because it gives an advantage tax-wise on the distributions. You can get a 20% tax break on the yield that the fund produces. In essence, makes your yield better than if we hadn't structured it that way.
Okay. Wow. Okay. That you said that was publicly traded? Sorry.
You can buy it through ticker symbol. Yep.
Okay.
Ticker symbol. Yep.
Okay. Got it.
Paul, what is that one? The one that's the ticker symbol. That's the FORAX, right?
Yes.
Yep. What are some of the primary investments within that vehicle?
Yeah, this is a really interesting vehicle. So you have public debt, which anyone could go in and buy, corporate piece of, Amazon, whatever companies you guys even mentioned prior to this. Then there's a whole another side of the universe that's private. Mm-hmm. And what we do on the private side is we lend to developers. Privately, there's nobody else involved in the transaction. It's developers that we've gotten to know or we've been introduced through over the years. Over 80% of our customers are repeat customers at this point, where they want to build a building. They don't want to go through a 10 to 12 month process of getting it from a regional bank and getting approved for it. And they come to our underwriting team. We do analysis on them and we lend directly to the developers. That is 90 to 95% of our loans that we buy in that product are off market. Other people don't even see them. And so that's the interesting access that everybody wants that they haven't had over time. In order to make it readily accessible for your clients, we also combine public CMBS in the same portfolio. But normally when people invest in CMBS, they invest in pools of CMBS. So there might be 500 bonds in that one portfolio. Some are good, some are middle, some are terrible. The way we structure it is it's called Single Asset, Single Borrower, CMBS, acronym SASB, SASB. So we're doing the same thing that we do on the private side, lending to one project, one builder at a time. It's just done on a larger scale. So the best explanation I can give so that everyone understands it, let's say Blackstone wants to build a $3 billion AI power generation facility. very hard to source $3 billion on the private markets. So they'll go to JP Morgan, Bear Stearns, Goldman. They'll create a public tranche that is a SASB piece, and we go in and buy pieces of that. And the combination of those two allows this fund to be available to everybody. And the only thing that people have to give up is it's not daily liquid, it's quarterly liquid. So you can get your money back every quarter instead of every day.
That's great. That's great.
And then, Paul, this can be used for anything, right? This could be used for a 40-unit apartment complex with retail on the bottom.
Yep.
Like anything like that. I know you use the data center, but it's really for any type of real estate. And I know the fund itself, right, predominantly is in multifamily.
Predominantly. That's our expertise. We built Google's campus in Boulder. We did a project at the Denver airport because we're located in Denver. It was okay. We did find it was two interesting projects. Our home base and our specialty, what we do the best is developing multifamily. So if we're going to decide who to lend to, it's predominantly going to be to multifamily because we understand the space better than any other space that we invest in. So we understand if someone's lying to us about insurance costs, materials costs, we can analyze the risk better in that sector. So that's where we stay. Another interesting area we've been lending to, which I have personal experience with, is student housing developers. So apartment developers. We've done one, University of Texas, Austin, Florida, the Gators in Gainesville, and we're building one at the University of Michigan Law School right now. And I'll give you a personal anecdote. So my daughter's a sophomore at Alabama. I didn't realize they only guarantee you housing 1 year. And then you have to go out and find apartments for the next 3 years. And her apartment was a certain dollar amount this year. And we got an email on a Wednesday a month ago that said if she didn't re-up for the same apartment by Friday, it was going to go up by $300 a month for the next year. And oh, by the way, there's a 65-person wait list waiting for that apartment. Wow. It's pricing power. So we look as Forum, sorry this is long-winded, but we look for opportunities that just make complete sense. So when a builder and a developer has such pricing power over rents, we're more apt to lend to that space. And so we do. And we have a great relationship with a large developer that's been doing these student housing. And so it's repeat locations with the same borrower for us.
Okay.
Yeah, that's great. I think what I think that's awesome about it is that a lot of people, I talk to people all the time, they want to own real estate, right? They're like, oh, I want to own multifamilies, but they don't realize everything that goes into it.
For sure.
So much work, little issues come up. There's a lot of upfront costs with purchasing the property and then getting the property ready because oddly enough, a lot of multifamilies, people who do own them, they don't necessarily keep up with every last bit of work to it, right? It's not their house. As long as the rent's being paid, they're not doing the work. So then all of a sudden you buy it and you say, oh, geez, there's some issues, right? Some warts with this property that I didn't realize. This fund, what I like about it is that it gives people exposure to the real estate rental space, but they don't have to do anything in terms of having to deal with tenants, having to deal, you know what I mean? It gives you guys like the experts who know exactly what needs to be done in order to make these projects run well. And it gives people a good yield, very low correlated with the market itself. So it's nice.
0.036% correlated to the S&P. I mean, in our world, that's virtually zero.
Yeah. No, so that's great because it's just something that I think over time, people have always heard you should get involved in real estate. You should get involved in real estate. This is a great way for people to reap some of the gains, right, that are going on with not having, right, so much demand in housing. So it allows you to get access to that, right, make some money in that area, but not get into a project that you really have no idea what you're doing or the expenses, everything that goes on with a rental property. This is a great way to get exposure in that area and make some money.
It's really interesting right now because lending, you can grab capital a few years ago for pretty cheap. And so you had a lot of people enter the development space that really had no right to be there. And what our founder started on the lending side of the business. It's pretty interesting. And he was lending for 3 years to developers. And he realized that over 95% of the time there was issues with development. It was with the developer taking risk with the debt. So meaning taking floating rate construction loans. And, when rates move against you and you have programmed in a certain amount for paying off the debt, and now it increases by 40%, you're stuck. And you either have to go back to your investors and ask them for millions of dollars, or you come to someone like us and ask us for a 12-month extension, where we're going to charge you quite a bit of interest for that. And then you hope that 12 months later, your financial situation is a little bit better and you can close out of that construction loan. And so we see a lot of this right now. So it's been a very interesting market. We're opportunistic, and that is us to a T. So we will develop if development makes sense. We will acquire if acquisition makes sense. We will lend if lending makes sense. And right now, it's a combination. Lending is still making a lot of sense because, like you mentioned, we're very short housing. So we need a ton of development to happen. And so lending will be a consistent force for the foreseeable future. Right now, we're seeing amazing acquisition opportunities. And it's because people are building these buildings. They're brand new. They're 94% occupied. So they're leased up. But they have a construction loan that they can't pay off because rates went in the reverse direction that they wanted them to. And so we're able to come in and offer these folks 30% below replacement value. And they are so happy. They'll take it because they want away from the project, right? They don't want to deal with this anymore. So we can get them out where they could basically break even with their investors, maybe eke out a tiny bit of profit. But we're able to acquire a building at a major discount that is brand new, leased up, and it's in a good location where we would want to own anyways. And so we didn't realize how fruitful entering the debt space 8 years ago was going to be for our equity side of the business at the same time. So it's really made us a full circle operation. It's pretty neat to see.
Yeah, that's really interesting. I feel like for a while it was maybe just, this is anecdotally, just looking at it, I like to look at real estate a lot. The multifamily side didn't make sense. But what is the size? Like when you say we want to acquire a building, are there buildings that are too small for you?
Yeah. Our typical purchase is about 130 units to 350 units.
Okay. Yeah.
That's our sweet spot. It's our bread and butter.
Got it. That makes sense. Are you, and then is it almost all residential, or is there any commercial? Do you play in the commercial space at all?
The only side of commercial you'd see is if we have a ground floor tenant. Let's say we put a Whole Foods.
Like a mixed use building.
Yeah. Let's put a Whole Foods on the first floor, consistent rent, long-term lease. Yep. And then the next 4 floors are multifamily apartments. And where we found our sweet spot is it's more everyday housing. It's not a $6,000 apartment in a high rise. Our rents are between $1,200 and $2,200. So it's consistency. Okay. It's more of nurses, school teachers. It's people who honestly can't afford to get into a home nowadays, but they still want a nice place to live with granite countertops, couple bathrooms, a gym, a pool, nice facilities, and we can provide it to them at a reasonable rental rate. That's our expertise.
So really, if there's a down economy, you're still fine because they're not like the high rises of New York City or whatever.
Those will get abandoned first.
Yep.
And then if you think about us as like an inflation hedge, our rents renew every year. When you're in a commercial structure where a store does a 15-year lease at a certain amount, you're stuck, right? Ours adjust every year. And by the way, we have tenants that come in January, tenants that come in February, in March and April, constantly adapting to the current scenario. So these are all advantages of real estate that before I got into it, I had no idea. You always heard real estate. You always saw wealth creation in real estate. And then once you start digging in, you can say, wow, like this is an underutilized asset class.
Yeah, no, it's good too. Obviously, these days, private credit, you hear it everywhere, right? Like private credit. And there's people think that you just hear it, you want to lump everything into one area, right? So you keep, there's going to be a private credit bubble. I keep hearing that a lot. And it's all right, but there's 200,000 types of private credit, right? There's all different like private credit investments that are going on, things along those lines. This is nice that it's like private credit tied back, right, to real estate.
Backed. It's in most private credit is corporate backed, right? It's balance sheet backed. What real estate private credit offers is asset backed. You're backed by a tangible asset that you can see, and you know what the occupancy is. You know how old it is, if it needs updates, and it's amazing. Firmly don't believe there's an end to private credit. There was a stat I heard earlier this year that blew my mind. Percent of companies that earn over $250 million are privately held.
Wow,
so
really?
When we CNBC and
you were saying 86%
are still they're private companies. That 86% of companies that earn over $250 million are private. So when we watch CNBC, we're really watching 14% of the market. And so when people say private credit is a bubble, I disagree with them. And I do agree with you that you need diversification within private credit. You want corporate private credit, and then you want asset-backed private credit. And that's what our debt vehicle offers is asset-backed credit on the private side.
Yeah. And I think that pool is getting bigger and bigger. There are less and less. There are fewer public companies every day that we can pull that stat and put it in the notes. But I think that's incredible.
And when we first started developing in 2007, we can get a 90% loan at a fixed rate for 40 years at 3.25% from HUD. Wow. We'd have to put 10% down. All of us on this call would be crazy to not develop as much as we could. And that's what our CEO did. But when banks started to get regulated heavily, they were no longer willing to lend you 90%. They were willing to lend you 50%. And we'd have to put 20% down. So that's 70%. And then you ended up with this break in the capital stack. And the banks needed partners to lend alongside of them. And so what do? They reached out to people like us who they had lent to us for 15 years. We had never defaulted on anything. We were never late. And they said, would you like to become a partner of ours on the capital stack? That's how private real estate credit works. I feel like everyone hears private credit and they think it's going to be some complex, crazy situation. It's not. It's us lending alongside of the banks to fill in the gap of financing that changed over time from when we started to now.
Is that all? Do you always have? So when you're talking about lending to a project, do you always have a bank as a partner? What's the mezzanine structure?
Yeah. Most of the time, this is very, very high percentage of the time. Yeah. The bank's going to be 50% of the deal.
Okay.
The developer themselves are going to be in the 20% range. And then we're going to fill that mezz and prep space, which is, our typical LTV is somewhere between 62 and 75 on the capital stack.
But you're taking a second position to the bank, though, on all those.
Yeah, exactly. Yep. But the bank loves having us because we have development capabilities.
Okay.
So let's say that the project up, right?
Deal goes south, you guys can step in.
And they absolutely love the fact that they don't just have to write off an asset. They can hand it to us. We will finish it, stabilize it, lease it up, and either hold it, which is accretive, or sell it, which is accretive, right? And so, we're a great partner.
Which I would imagine that's very rare as most.
Very rare.
Yeah.
Very rare.
In those situations, are you able to negotiate a bigger equity chunk? Or if you're going to the auction, right? Like when properties make it to the auction, the banks are like, we don't want this. Like we've tried our best. We're washing our hands of this. Is there any moment, or you just say, hey, we'll take the development on?
Negotiations definitely occur. A lot of them are already pre-written into the contract before anybody signs anything. I think we most likely already know our scenario, even in the worst case, prior to it happening.
Got it. Right. All right, so I want to take a step back here. This has been awesome. Bill, Eric, how much of a portfolio, when you're working with clients, and I know that we customize our client portfolios. How much would you say, hey, we're looking at alts, right? Like real estate versus equities? Maybe Bill, you can start, and Eric, or Eric, you answer.
Yeah, tends to be for a client that doesn't have like liquidity needs, especially with the quarterly. You can only access the fund quarterly.
Yeah.
But hey, you might have a client who doesn't want a ton of exposure to the S&P 500. They want to add a little safety net there. Maybe you put 5-10% in one of Forum's funds, and it gives them an extra bit of diversification, because it's getting harder and harder nowadays to diversify away from the S&P. If you own a fund, you're basically owning big tech.
Yeah.
If you don't own big tech, you're going to miss out on a lot of the returns too. But hey, you want some consistent yield and some diversification, we'll add a piece of Forum into the portfolio. But typically you might go with a client who doesn't need the liquidity right away, or maybe they're a little bit higher net worth, something like that. At least that's what I would do personally. I know Bill could have different scenarios with clients as well.
Yeah, we can still access it quarterly. Yeah. So as long as we do on the planning side of things, where we make sure that the cash flows are in hand, so maybe a couple quarters out, we might be looking at more liquid investments like treasuries and things like that, just so we're getting a little yield on their cash management side. But as long as we do that, now we can utilize something like Forum just to get more yield for the client, right? So rather than getting 4%, right, we might be getting
9. I
don't know, like 8, 7, 8, 9, 10%, right? I know.
Yeah.
It's going to vary, right? But yeah, Paul, you could probably speak more exactly what we're looking at there. But I think like year to date, for example, it's around like 7.4%, right? Is what the yield has been.
It's actually roughly almost as high as 9 right now. It's 8.77. Okay. We've been increasing our private exposure this year. It's more stable, and when we lend to people now, we're lending somewhere between 14 and 16%. So the more of those you add, the greater the yield.
But that's in addition to the tax benefits you're getting.
The tax benefits would go on top of that.
Yeah. So
you're getting that section 199A.
Yeah.
A lot of people will see. So that's where it allowed people in real estate, certain investments, right, get a 20% adjustment to their income essentially, and so it's a great little tax deduction.
That's a great yield too when short-term treasuries are yielding like 3.8% right now, so you're doubling that up.
Yep.
So if they don't need the money, it makes a lot of sense.
So you guys are really looking at from a client perspective, clients who are looking for a little diversification. The 0% correlation to the market is fantastic, and it allows for more of a tax efficiency play at the same time. With is that it?
The having that deduction is nice. I wouldn't say it's probably the most tax efficient, just because it's tax at ordinary income. It's essentially like an interest or a dividend income that's coming in.
Okay.
But it can be used in both qualified and non-qualified accounts, right? It really just depends on the needs of the client, what they're looking for, and what their asset allocation is going to be, things along those lines.
I mean, it's also inflation proof, really.
Yeah.
Or there's some protection there.
A lot of our clients look to utilities for dividend yield, but we've seen it with the independent power producers that utilities have had quite a big run up. So it's almost like some people start to question, are they still kind of the least risky asset class in the S&P 500? Here's another product that gives you that dividend yield and gives you that extra diversification if you're worried about utilities being overpriced based on the big run-up they've had where people think energy prices are going to keep going up because of AI capacity needs.
Yeah. And I was going to say, too, you don't need to, on the interest that is earned, you don't need to invest it right back into the fund. So you could just take that in cash, and that gets distributed monthly. So it's a way to get some income yield there. So even with the fact that you can't get principal back, that has to be done on a quarterly basis, the interest itself.
Okay.
That can be put right into your account. So it's you have access that way.
Got it. Paul, do you think rates are going to continue to go down, and how will that impact Forum?
I mentioned earlier, we're in the camp of higher for longer. So I think rates will stay steady for the most part. I don't think it's going to be a large move in either direction, and neither do we. The only area where it really affects us is, let's say we're lending on the private side right now, and I mentioned we can get 14 to 16% for a 3-year loan to these folks. Maybe it drops to 12 to 14. You get that incremental drop of what you can charge people for the interest. But if you look at the advantage of being in this over a treasury, which at the time will probably be 3%, 3.25%, that spread is still well justified for the risk you're taking on and the quote unquote lack of liquidity, quarterly liquid.
No, absolutely. That makes a lot of sense.
Paul, if you guys have a customer that like defaults on their loan, do you guys never do business with them again? Like how does that usually work for you guys?
There's nothing set in stone.
Yeah.
But I would tell you they would have a very hard time to ever utilize us again. Now, we are in the construction business. We've been developing since '07. We do realize that sometimes things happen. But our belief is our due diligence runs so deep before we actually give people money. You know, our fund has 42 holdings in it because we don't want 1,000. You can't know who you're lending to at the level that we know if you lend to 1,000 people. So we're lending to 42. So normally we know them pretty well. But yeah, if anyone went through, let's say it was because they falsified statements or lied, or which again, that's our due diligence, is to avoid all that. You would have a very hard time to come back to us and ask us for money again.
Right. I'd imagine. All right. Do you guys have any other questions? I think we're getting to the end of the show, and I'll move on to the rapid 3 questions if there's nothing else here, unless we missed something.
No, I think I'm.
All right, let's jump into it then. All right, yeah, this has been fantastic. All right, rapid 3. The rules of the game, Paul, are 3 questions, really fast. Okay, you can skip if you want, but we ask the same questions to every guest. All right,
I'm nervous now.
Yeah, no, it's a fun game.
I'm only kidding. Yeah, just kidding.
All right, so if you could go back and give your 20-year-old self one piece of advice, what would it be?
Walk into every single bank you can find, borrow as much as you possibly can, and buy as much real estate as you can. Cash is king, right? And cash flow is even better. So if you can have apartments that are providing you cash flow and you continue to develop and all of a sudden you have 10,000 of them, that's the advice I would give myself. Own as much real estate that's providing cash flow as possible. So I actually reverse that. Cash is queen in our eyes. Cash flow is king. Sorry about that.
Yeah, that's perfect. Yeah. Okay.
A little harder to come by these days.
But if you think
back then, they were plentiful.
When we were graduating, if we just grabbed as much capital as we could, forget it. It'd be a pretty good scenario right now.
Yeah.
Oh, for sure. All right. How do you personally define wealth? That's the second question.
Wealth is not a monetary thing for me. It's family and happiness. My wealth is watching my kids succeed. And Eric knows my son's a football player. And Eric, tonight he was told he's getting a ton of playing time.
Oh, all right.
Should be a good game tonight.
Wait, where is this game?
This one's at LaSalle.
Dude, I went to the North Kingstown game, but we forgot to bring my kids like headphones, so we left after the first quarter. But anyways, go
He threw a 70-yard touchdown that game.
So
my wealth is being comfortable enough to live where you're not laying in bed stressed out about your bills, but watching my kids become leaders in the next generation. That's my wealth.
I love that. All right, and last but not least, what is one book that you've recommended people read the most?
Lone Survivor by Marcus Luttrell. I'm a big Navy SEAL fan. I've got a bunch of kids. A lot of my friends growing up. Actually, 3 of them became SEALs. And so I'm close to the community. And if I read that book and I hear and visualize what those 4 men went through, it's a question of, I always say, would I have been able to do that? Yeah, I highly recommend it.
Okay. Lone Survivor.
Yeah, by Marcus Luttrell.
Okay. All right. Awesome, Paul. Thank you so much for being here, man. Yeah, we'll have to have you on again. This has been a great conversation. Thank you so much.
Happy to do it. I actually enjoyed this. Yeah, thanks.
Awesome.
Thank you. Yeah.
All right. We'll see you guys. For all our listeners, thank you for listening. If you found value in this, please give it a share, follow. That's how the show continues to grow every week. And we'll see you guys next Friday.